Hello and welcome to the Harwood Report for February 20th, 2018, presented by Trade Academy. I am your host and the founder of Trade Academy, Keith Harwood. Had a nice long weekend, and now we're going to get right back into the markets and see where we see things going. But first, and as always, the disclosures. All services and content are provided for educational and informational purposes only and are not intended as legal or financial advice. Please read the rest of the disclosures. Moving forward, highlights for the week. Focus on the equity indices. Things had gotten a little bit jumpy with what's going on with Mueller releasing some details about the Russian investigation and some of the people that they're going after. Bonds are going to be impacted this week. Tomorrow, Fed minutes. Gold will be impacted tomorrow, Fed minutes. Oil, always worried about EIA. And, there's some stuff changing in oil that gets me a little bit excited right now as well. So with that, I'm going to go straight into the charts with a brief stop off at fear and greed. This level is too low given the fundamentals of the market. If something changes in the Mueller investigation where they go after somebody closer to the president, maybe that justifies a fear level like this. But frankly, what we saw 2 weeks ago doesn't justify this kind of fear. VIX has started to fall, still has more room. I'll look at that a little bit as well. Market momentum is starting to come back. Put-call ratio is starting to come back. Some of the stuff is basically turning. The big stuff is really the new 52-week highs that need to start being created again to really push this number back to a reasonable level. But as we've normally seen in the past, when we get down to this kind of level, we get a nice bounce back in the market. So, for me, a bullish lean. And that starts with S&Ps. Tested the 200-day, took a brief stop at the 100-day moving average. Now we're taking a brief break at the 50-day moving average, a push above the 10-day moving average. The 20-day moving average there at 273.5, and we're above all key moving averages once again. We are very close to that level already. I have to have a bullish lean based upon this, the MACD cross. All of this gives me some belief that maybe we go higher and probably press back into these recent high levels around 280. Maybe not this week, but maybe this week. If the Mueller investigation comes out, if they come out this week and say, that there's not much left, I don't think that's going to happen, but you never know. If they say there's not much left, that could give a spark higher. Fed meeting minutes could give a spark higher if that helps put some confidence that they're going to be careful about what they do to the market when they raise rates. That could give a spark higher, because that's what really started the spark lower, was fears that they would raise rates too fast and slow the stock market. So the right Fed meeting minutes on Wednesday, that could be our catalyst for a move into the 283 range. It could also be our catalyst for a pullback. I don't necessarily believe we're going to get that pullback to the 200-day moving average. A pullback to me would be back towards the 100-day moving average. But for me right now, it's a close above this 20-day moving average with a tight stop tomorrow, because tomorrow's the Fed meeting minutes. And then if we stay above the 20-day moving average tomorrow after the Fed minutes go, I think we're going to push towards 280 fairly quickly. So the thing that I need in order to really make some money off of that is cheap volatility. And frankly, it's not that cheap right now. Yeah, it was really expensive, but cheap is 13, 12, 11, 10, 9. Right now, it's 20. Options are going to get cheaper if the market rallies back to 280. I can structure trades around that. I'll talk about that more in the premium newsletter that I'll have out later today, because I think that that's something that requires a little bit more of a nuanced trade. But I think VIX is going to fall, particularly once we get through the Fed meeting minutes tomorrow, particularly if it's bullish. And that can help rewind up some positions, push the market back higher, and allow us to get back into the new all-time highs every day mode that we were in January and all of 2017. It's going to take a little bit of time probably after we get to if we go straight to 280, I expect a little bit of consolidation before we take the next leg higher. But, frankly, I wouldn't be surprised to see a bit of a bullish lean coming out of this week. Next up is, we'll go to the Qs first. So the Qs are pressing against yesterday's high. Semis have been really strong here. Really good day for the semis. That's been one of the big catalysts for the Q's move today, is that semis have been strong. That is a big factor for the market. People are starting to put some money back into some of their old favorites. Look at Nvidia, new all-time high. Micron, starting to look a little bit stronger here. It's still not to a new all-time high, but it's looking better than it was. AMD, that had gotten destroyed here, and now that's starting to even show a little bit of strength. It's got a little ways to go. Nvidia, of course, is the big boy, and that thing is incredible. Intel looks a lot like Micron, but it's these are names that are above all the key moving averages now and pressing higher. We could see semis bringing us out of this. The thing that makes me a little nervous about the Qs is what has been on my radar for a while now, and I've looked at this a few times with everybody, and it's this. Qs are at an extreme premium to the small caps. If the Qs keep going higher, small caps have to catch up at some point, particularly with yields rising. Yields rising should be bullish financials. Financials are a big part of the small caps. So when I look at the small caps, given what's going on in the Qs, given what's going on in SPY, this is an area where I think very easily we could see 158 this week, 159 this week, or even 160 this week. Because 160, with the Qs where it's at, would only be a $6.50 discount to the Qs. That range, as we saw here, traditionally it trades around $6.50 discount. That takes a couple weeks to play out. But if the Qs keep pressing higher towards 170, IWM has to play some catch up at some point, and I get it. People want to buy strength, and the Qs are the strength right now. But with TLT weak, financials should be strong. That should put some money flow into the small caps. So that's something to watch tomorrow. Again, because if the Fed comes out and really presses TLT lower, that actually may mostly pull back the Qs instead of pulling back IWM. Because financials can get some money flow to help offset the losses potential in IWM, but really pull down the Qs because people are then just worried about ways to sell the market, and they will sell some of those high flyers that they just got back into, such as the semis, such as Nvidia. So that's my big fear mode right now, I think, is if I see something that pushes the market a little bit bearish tomorrow, I'm looking for a short entry in the Qs. Bullish, I'm actually going to look for the IWM to play catch up. I've been looking for that for a while now, so it's taking a little longer than I expected, to be perfectly honest and blunt. But I think that given where volatility is, IWM's not a bad spot to be long a couple of calls and know that catch up, on a move to 160 could really could really pay off even with long options, because the vol here isn't that extreme relative to its high point. So its highs tend to be around 15%. The lows tended to be around 12%. It spiked to 24% when the S&Ps were going crazy. If I can get long vol anywhere around 14 to 15%, I'm not in bad shape here. I have a small position right now for March 9th, long the 155 calls, around 16% now. Vol's up a little bit today. It was 15% last week. I don't mind being long some 15% volatility. I'm starting today from scratch. I'm looking at March 16th. I'm looking at the upside, and I'm looking at some of these, basically calls right here in the 157 range at sub 15%. Sub 15% is not all that bad. I'd like to see vol come down a little bit more today before I go into this, because I think that vol should come down a little bit more today, given that the market on the whole is green. So if this can get under 14%, that's where I'm a little bit more excited. So I'm going to be watching the March 157 calls, looking for vol sub 14% into today's move. I mentioned TLT, and I want to come back to TLT. Oh, I'm on TLT still. So in TLT, you can see that we're testing against the lows here. We've been doing a little bit of chop the last week or two. Friday, tried to test out what it was like above the 10-day moving average, and today we're back below. I think that this naturally kind of needs to occur with how far away we are from the longer-term moving averages. MACD looks like it may cross here. That could give some people a little bit of excitement for the bounce, but I don't think we're going back to 125. I think we're going to go back to 121, 122 if we get there. So let me think about how that could be played out. And first, we're going to start with the TLT vol, because TLT vol is actually very cheap. So IWM, the high of that range tended to be, we would be trading around 11.5, 12% in TLT. TLT vol, the range tends to be between 9 and 12. And right now we're sitting a little under the upper end of that range. Just for perspective, let's look at SPY here on where we are relative to the range, because that's the big one that's been moving. Obviously, the high end of that range tended to be around, over the last 6 months, around, there we go, 10.5%. And right now we're still trading at 15%. So we're trading 30, 40% above the normal range of SPY vol. So TLT being at the upper end isn't particularly expensive when I compare it to the other macro products. And if I look onto the upside, looking for a bounce kind of play, and looking out into March, which has the next non-farm payrolls, has this week's Fed announcement or Fed meeting minutes, the 122s may be a little too high. Those may be dead. But if I'm playing for a bounce, these 120s for 50 cents look pretty attractive at 11%. So that's something I'll be looking at today here. It's TLT March 120s, 50 cents. I think that's a really good way to play this defined risk. I hate catching a falling knife in general. I tried it with some calendars earlier. Now that vol's low enough, I don't mind trying to catch this falling knife with cheap calls, knowing that if the market turns around, I can get quick leverage and paid off very fast. And if I'm wrong, I'm only risking 50 cents. It's a heck of a lot better than being long stock at 117.80 and watching it drop to 115. So that's where I'm looking right now in TLT, because the volatility level is not that expensive. It's not cheap, but it's not that expensive. One other thing to note, I mentioned financials, and I just want to take a look. KRE pressing against all-time highs here, or 52-week highs at least. I'm not sure if it ever traded above there. I imagine not. XLF is a little bit slower to catch up. KRE is, of course, a smaller cap name, so it has some of the smaller cap banks. And so that's, something that I think needs to be watched here. If, say, the market as a whole firms and TLT is able to remain stable or even lower while the market's firming, that could be a really good catalyst for KRE and XLF to trade higher. Let's go over to the precious metals. First off, the dollar index is bouncing, but it's still near the lows. It's kind of chopping here around the 10 and 20-day moving average. There's not a lot of clear trend here in the dollar index. If I go to dollar yen, which has been my main focus when I look at the gold trade, it's still weak, but it's bouncing today. Until it takes out some sort of moving averages here, I can't have a bearish lean in gold, but if this gets taken out, I can start looking for a bearish lean in gold. If this is just a dead cat bounce, we're going to see a move probably up here. Maybe we reject at 107.65. Maybe we reject at 108.32. The last time we really rejected was on the 20-day moving average. So we're going to move towards 108.32 and then start to fade. That's where I actually want to get pretty aggressive getting long gold because of the pullback that's been happening in spite of this weak dollar yen. Today's move was pretty drastic. Obviously, last week on the 14th, we had a pretty drastic up move. And on that day, there it is. We had some here. The continued weakness did not generate a lot more momentum into gold, and so that's just kind of unwinding this little three to 4 day move right now. If dollar yen continues to look firm, I'm looking for gold down to 122. We may get a little too close to that range before I'm truly bearish, in which case I don't get any leverage. So if gold drops down to 124 before I'm getting my signal out of dollar yen, I'm not going to make that much money on a $2 move. Where I might make some more money is actually out of GDX, where we have nothing, not much below us. If we get below these levels around 21, we can get a quick move sub 19. That's a bigger move. Now we're talking about a 10% move instead of a 2% move. I like it. I like playing leverage for a 10% move. I don't like playing for leverage on a 2% move in GLD when vols are, only about half of that at GDX. GDXJ looks a lot like GDX. The vol there is not particularly cheap right now, but if we're talking about a move down towards potentially 28, I can get some leverage there. So if dollar yen continues to be firm, I'm going to look bearish on the miners. Pull up one more here, SLV. We're below this consolidation area. If dollar yen weakens, I like going into gold because that's closer to the highs and that's got that potential for a spark. But I also know that SLV is another really good way for me to get in there. My only concern is that we may consolidate here. If gold turns around and silver turns around before the dollar yen really weakens, it's unlikely, but you never know. I mean, something could happen with the Fed meeting minutes tomorrow that causes them to move a little bit before the dollar. Then I want to keep silver in my back pocket as the alternative. Because if silver and gold both rally and silver gets back to, say, 1605, while GLD is making new highs, then I have to actually go over to silver and look for that big move. Because gold, at 130, it's a new high here for this last year and change. But I mean, I got to think that silver is going to push towards 17. That's another dollar. So I've got $1 of room to play with in silver if the commodity story starts to get a little more bullish overall after the Fed meeting minutes tomorrow. Again, it's all about after the Fed meeting minutes tomorrow. So if TLT is weak after the Fed meeting minutes, I'm watching the stock market for clues on whether we're going to go short the Qs or long IWM. Or for that, I mean, that'll be my play basically. If the stock market on the whole looks weak, I got to go short the Qs. If the stock market looks strong, I'll go long in IWM. If TLT looks strong, that may take out some of the IWM, but it's already at such a discount that I'm not that worried. TLT is strong. I expect gold to be strong. I expect silver to be strong. I expect the miners to be strong because that's going to start probably putting a little bit of pressure on dollar yen. So it's all interconnected here. Vol is still a little bit high in the metals, so let's hope that that kind of gets hit for some reason today or tomorrow or right after the Fed meeting minutes or something like that. Finally, I'm going to go into oil. Start with the euro because the euro does have a correlation long-term to oil, maybe not day-to-day, but the euro has been strong. The trend is euro is strong and dollar is weak. Today, the euro is weak relative to the dollar, but overall, you can see this clear uptrend in the euro relative to the dollar. USO, it looks good. I mean, it's starting, if the day-to-day correlation between the euro and oil was there, then you'd expect the USO to be a little bit weak. But as that uptrend continues, I should expect to see an uptrend in oil. I think oil got hit a little bit because of that concern of what's going on in equities overall. It's a global macro issue. Right now, it's pressing back towards highs. Oil is a sector I really like, particularly given how much they hit XLE. Some of this was off of earnings. And OIH. OIH was actually hurt a little bit less, but now it's really down there at the lows too. So OIH initially didn't get hit as hard and then got hit harder. I wouldn't be surprised to see OIH press back towards 29 on a move in USO up, 50 cents. So if a 4% move in crude can cause a 20% move in OIH, that's where I can get some leverage. Sorry, I guess not 20%, just under 20%. 18%. Now I don't want to play for a full move to 29 because that's the sort of outlier play. I easily could see this move to 27 to 28 though, as long as oil stays firm, and it's continuing to look like it's going to do that. I mean, crude oil today is firm, and yet they're not really buying oil names. OIH, vol is not. It's not cheap, but again, it's not that expensive relative to the other oil names. So OIH, you can see it's kind of at the upper end of their range here at 31%, while XLE is above the upper end of its range, which is normally 18%. And OIH has that explosive potential upside. Realized vol has been higher than this implied level. I just think this has been it's got a lot of potential. Let's just say that. When I look at the March, and this is where I've been focused in here, and I've been very patient, and I'm running out of patience. I think it's getting to the point where I just need to do some stuff here with oil for this potential for a move. And I can capture non-farm payrolls, I can capture the Fed meeting minutes, I can capture a bunch of oil reports, I can capture a lot of catalysts that could get this market going by going into the March 16th, 26 calls for 30 cents. And if we can get a move to 27.5, those are worth $1.50. And go to 29, they're worth $3. And I imagine along the way I'll be rotating and modifying my position. But this gives me some balance of gamma, vega, and then I like the strike of the 26s because of the move that I'm seeing is potentially there. The key here is as well, last week's high. It's 24.71 right now. We're trading 24.59, and today's high was 24.73. So we've taken out last week's high very, very lightly. But if we stay firm here and close above 24.71, I think that's going to give us a catalyst. 25.5, 26 could be there in very short order. And that's why I'm thinking that these March 26 calls have some really good potential for me. So that's how I'm looking at the oil names there. And that's going to wrap it for today. The Harwood Report, I mentioned the premium stuff. I'm going to talk more through IWM, the Qs, the trade strategy there, and how I'm looking at it. A little bit more about TLT, a little bit more about gold and the miners, because I touched on how I want to kind of position, but I didn't touch on actually the option metrics that I'm looking at for this free stuff. I'll get into more of that for the premium newsletter. The first month is free, so there's no risk to you if you want to try it out. I urge you to do so. See if you get any value out of it, and if you don't, you cancel and you pay nothing. Otherwise, it's $49 a month after that. Contact me for if you'd like, Keith@tradeacademy.co, or call me 312-600-8004 if you have any questions or comments. And if not, I hope to see all of you signed up for the newsletter later today. And if not, we'll talk next week. Good luck to all and happy trading.